Welcome back to the Capital Mindset Show. In the newer fashion, we have a denser video for here today. At the end of the video, you'll have two analysis parts on two different companies I discussed. I would talk last week. Okay, so now here's the video for it. And in the beginning part, we're going to be discussing everything that's going on, the fear porn, so to speak. So market is down. On a technical basis, we are looking at a bear market. If we pull up the SPY here, we are down 21.25% year to date. So technically, it is a bear market. I also want to highlight for you the TLT. TLT is down 3.3% today, as well as with the market. So in a broad sense, there's nowhere to hide, everyone. There's nowhere where you can put your money right now and hide. Of course, that's not necessarily true. There are hedges that someone could have made, and this is, for example, the short version of TLT. Not to recommend it or anything like that. I'm just giving you an example. So this is actually up today, 9.84% here today. Of course, we actually in the portfolio have a couple hedging positions, not this one in particular that's showcased there, but we've discussed them here and there in the past. Now, what the heck is going on? Well, if we actually want to talk about the liquidity crunch, and if anyone's new to the channel, you can ask any of the subscribers that have been following us for at least a year now, well, at least since December of last year, what is a liquidity crunch? They'd be able to basically tell you at this point. And with all that being said, I actually want to segue over to this news that Celsius has frozen accounts, dealing a blow to the Bitcoin hub. This is from some article, but you'll find the story everywhere today. And what is that being said? Okay, so Celsius basically said, you can't take your money out. We covered this in the Voyager stock. Now, in that stock, we wanted to, or that video, we wanted to highlight to you guys, okay, well, these are the risks in the broad sense for all of these brokerages. And then aside from that, here's the thoughts on Voyager specifically. But in a broad sense, all these brokerages have the same amount of risk regarding that you don't technically have the right to take your money out whenever you want. They can technically freeze it because it's not really your money. It's more of a collateralization of assets. And we have to consider counterparty risk. What is counterparty risk? Well, let's say there's Joe over there. I'm going to oversimplify this example, but there's this guy called Joe, and you're investing in me. I pay all my bills on time. I'm great. I'm a fantastic person. But Joe, we don't know about Joe. You don't know about Joe. I'm kind of believe in Joe, but you're looking at me as the investor. You invest in me, and then I put all my money in Joe. Let's make it an extreme example. Then Joe does some shenanigans and loses all the money, right? Well, you didn't analyze Joe, so let's say that's the counterparty risk in this example. So because of that, you thought that I was safe. I was a safe investment, but because of that counterparty risk I had with Joe, and I was doing business with Joe, that makes it an issue. That broadens the risk profile of this investment that you didn't even realize, and that's the danger of this. I want everyone to kind of remember this as you kind of see, as creators kind of highlight all of these different brokerages for you to do. I think that if you must be involved, and remember this when you see people talking about crypto, because crypto videos do get a lot of views. Let me just say that. I could have actually utilized this as a form of growth. I chose not to because I think it's irresponsible. But in a broad sense, my only comments on it is if you wish to participate in crypto, please, 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 for the love of everything, do your research in terms of the risk profile of where you're storing your assets. Please understand how the mechanism works. I can't even tell you when I was actually discussing with a friend of mine the Anchor protocol, okay, and how that actually was utilized with Luna, and that blew up, okay, and how that was so nerve-wracking, how dangerous that was, and it ended up actually blowing up. But with all of these brokerages, there's this other risk that people really are not paying attention to. Now, I want to highlight, just for a key point, this particular post that I think is aging really well. And it's on the Instagram page. I did talk about it. I did make videos on it, but there's a problem. If you're in the United States or depending on the country you're in, you can't actually see this video on YouTube. So it is posted on YouTube. You just can't see it. So I recommend if you guys want to, I'll put it in the link in the description below to this video on my Instagram. And again, if you follow me on Instagram or you're not following me on Instagram, go ahead and follow me on Instagram. I like to post a lot of memes in there. And so I did post about it here, so we're going to have an inception moment of me reacting to a video of me and me right now, so three of me appearing on screen at once. But, you know, we're not going to react to this video, but I made a video talking about how this was restricted. This was the video in question. It is restricted because it is using a office meme. I thought this scene really explained the situation, and this was posted in January, so keep in mind what the context of the time was. I thought well, I always think my memes are going to age well, but this one's aging really well right now. And so I just want to highlight that because these memes, you have to find a scenario or a scene in a movie or show that kind of fits with the theme, the overall message. And I think memes are a very powerful way to communicate something in an entertaining fashion and not just a boring lecture-based, oh, big words, blah, blah, blah. This is something everyone can get behind and understand. So I think it's pretty funny. I'll only play a couple seconds of it. And then again, I can't because the YouTube gods will not like it. All right, so here we go.
Today, smoking is going to save lives.
Okay, so I'm going to pause it there. Again, that's just a little sneak peek. You guys can check it out on your own. And regarding all of this, I just want to also talk about how when someone tells you the bottom, right? We want to talk about timing the bottom or anything like that. There's a big issue. So we've been talking for quite some time about the liquidity crunch. You might hear creators or news stations talk about it in the liquidity crisis or in that form. It's pretty much the same thing. But in essence, we were discussing it for quite some time. There's easier ways to identify these things. There's the canaries in the coal mine video where I discussed that and how all these stocks that we were discussing or highlighted in the canaries in the coal mine video were in fact that. And a canary in the coal mine simply is that bird that coal miners just bring back in the mines. And when it died, it told the coal miners, hey, the gas is, it's time to get out. It's time to get out of the mine because you're all going to die. So this is not to say that, you look at these canaries in the coal mine, you just sell everything. You might be saying, well, Fabio, that's kind of hypocritical a bit because you sold the banks, you sold some of your stocks like Walgreens Boots Alliance, and you sold your REITs, right? Those are the ones you sold. So you did sell. And I was like, well, not necessarily. What I'm talking about is getting fully out, timing the market, saying, oh, that's the bottom. I'm going to sell now so that I can wait for the whole crash and I'll re-enter. We have a problem. Well, let's point to a creator that did do that. And actually, he's mentioned in that meme because it kind of predicted his behavior. So we're looking at like Meet Kevin, for example. Meet Kevin timed the bottom twice at this point because he kind of said, okay, this is the bottom. No, it's not. This is the bottom. So he kind of re-entered and he purchased the wrong asset. I think Meet Kevin is a good example of someone who kind of almost touched upon it. He was just squeezing upon the potential that he might have identified that there was a liquidity crunch. And then when he didn't really identify it, of course, kind of culminates into he performed the wrong action. And top of that, when he went back in, he purchased the wrong kind of asset that you would want to own in liquidity crunch. He didn't buy one of the canaries. He bought one of the ones that are kind of like the last bastions, which was Tesla. Tesla and Apple were identified them as the last bastions of this liquidity crunch. When they start to kind of collapse, that's when we know, okay, we're fully fledged in. Though they're not canaries. So I identified canaries such as ARK, such as a bunch of other stocks like Tattoo Chef. A bunch of these YouTube stocks were in fact the canaries. Tesla and Apple were kind of like the bastions where a lot of money was just in there and then kind of need to get squeezed out towards the end. So it's kind of happening now, but we'll see. And of course, that statement might not age well, but we'll see. I think it's going to age well. I think it is aging well now. And again, those are previous statements. But I also want to say caution to anyone who tells you the definitive point of the bottom, because, okay, it's far easier to identify that there's something wrong in the system, that there's a potential for something. That's very easy to do, or much easier than the next thing. And the next thing is identifying when it will end. That is incredibly difficult, and I'd caution anyone, if in fact, most of the time, if not every single time someone accidentally does it, it's an accident. It's not exactly the time to be buying. So, for example, my strategy really hasn't changed all that much, right? I did exit out some positions. I did change my sentiment towards acquisitions. Now you can see I'm identifying, I'm telling you, I've been expressing this idea for quite some time, that I'm starting to get more aggressive, because I don't think we're at the beginning of this anymore. I think we're towards the middle. End is like cautious. I'm not so sure, but we're definitely not at the beginning. How do I know we're not at the beginning? Because everyone's talking about it now. So I've seen a lot of creators, a lot of news places now talking about the liquidity crisis. Of course, all this was not to be surprised. It was not a surprise. Again, easier to identify that there is an issue going on. Much harder, nearly impossible, if not impossible, to identify when it has ended. So it's like you're in a storm. You can see the storm from far away, okay? I think this metaphor works. I can see the storm. Once I'm in the storm, it's very hard, once I'm in the center of the storm, to identify that the end is like, in 5 minutes, right? And we're not talking like, using technology. I know with technology, yeah, but whatever. We're talking about you're in the storm as a person. You can't see the end because it's just cloudy everywhere. Okay, so that's kind of like the example, okay? And most of the time, people will fail. Okay, they will fail. They're gonna fail at this. And this is why when you see JP Morgan statistics on the average investor only generates about 2% rate of return, they underperform, it's because of emotion, it's because of psychology. They're gonna fail. They're not gonna do the right thing. They're gonna, in fact, it's kind of poetic in a sense, because in trying to resist it, in attempting to do this, you are going to most likely fail. You're most likely going to cause the very thing you tried to stop, which is the funny thing in and of itself. So I think the most successful strategy for any investor at any point in time, easier said than done, is to purchase assets at prices that they deem attractive, that they desire. Okay, assets that they desire at prices they deem attractive. Easy, done. That's it. So if someone focuses on that, they're going to be probably better off. So for example, dollar cost averaging into index funds. This strategy, the reason why it works so well is because it removes the psychology aspect. If an investor truly does that, they truly dollar cost average into index funds, it is removing that part of where they could be, oh, should I buy now? Should I sell now? No, you're kind of removing that part of the equation. Now, that doesn't mean that, okay, sentiment of, oh, you're going to be a little bit more cautious in terms of your contributions than later. That's not necessarily timing the market, is it? Timing the market, if we define it properly, is saying, I think the market is going to go down. I'm going to sell everything now because I'm going to buy it back later at lower prices. Otherwise, if you're timing the market and you're only selling a piece of your portfolio and leaving the other part in there, if you're so sure that it's going to fall, why not sell everything? It's idiotic. Okay, so because in essence, because that's not timing the market, because that individual is understanding that there is a degree of uncertainty with this, it's more of a cautionary behavioral standpoint, not necessarily definitive or necessarily precise in nature, that we can distinguish between the two scenarios. All right, so that's pretty much it. I think that you want to actually kind of identify when someone is telling you something that can be pretty dangerous in a sense for the newer investor, and why, as an investor, you should focus on your principles. You should focus on your core principles regarding what it is you want to own, what prices you want to own. And I think that's going to make everyone more successful and not worrying too much about the other stuff, okay? And that's why paying attention too much to all this noise is problematic. It's going to cause most people to, in fact, lose, okay? Now, as far as how I'm doing, I am going to be, again, as per typical, as what I've been telling you in the past several videos. As you can look at the strategy change video. It's not really strategy change. I did that because, whatever. But regarding what I'm doing, I'm getting more aggressive, and that's it. I'm buying more assets at more attractive prices. Of course, in more detail will be always in the portfolio update videos. I will discuss what I've been buying. But it's so boring because it's the same old. So if you guys have been seeing what I've been buying recently, it's the same. So it's no different. And one last thing about this liquidity crunch. We've been discussing this on the Discord. People have asked me, okay, what about Ally Bank? Ally Bank, and there's one other bank that I don't like at all. But Ally Bank is one that I said that you definitely don't want to own this kind of asset in a liquidity crunch. Why? Well, because what is on their balance sheet? Not all banks are created equal, okay? If I'm going to reiterate some of the older points, this is it, right? Ally Bank focuses primarily on auto loans. Auto loans are considered to be more assets, disgusting assets that might be held on the balance sheet of a bank. Ally has plenty of it. That's actually what they focus on. We discussed this in the Ally Bank video. But yeah, regarding their performance over the past year, it is down 35%. It is now down 28% year to date. This drop here today is very well deserved. I think that this bank will struggle tremendously going forward if the liquidity crunch kind of persists and worsens over time. So that pretty much is it. That kind of summarizes all of the negativity that I wanted to discuss with you here today. You've been probably seeing other creators talk about it in various different contexts. Maybe they're a little bit more negative, maybe they're less negative. I, again, am going to say to you one more time that if you focus too much on that, there are some, instances, some types of assets that you want to be careful of. Again, that's typically why index funds work more, because the average investor is not going to be able to pay attention to all this stuff. And because of that, they're not going to understand really what they own, and that can lead to underperformance, not understanding what it is you own. You look at Ally Bank, you see that P ratio, and you're like, oh, it's a P ratio 4.24. That's so cheap. The dividend yield, 3.45%. That's so amazing. And then not understanding what it is that they hold on the balance sheet, or understanding, okay, why does that even matter? And yeah, so I disagree with some instances when some people say, oh, well, the macro doesn't really matter, or the macro situation doesn't. No, that's not necessarily true. It really does depend it's investing is extremely nuanced. Making broad assumptions about anything tends to be incorrect, and usually shows in the investor's performance when they do that. Especially if they're participating in a business that might have very specific changes that might affect its business model over time. And if you make that broad-based assumption and you're wrong, yeah, you're going to see it. But regardless, that's kind of what I want to highlight today. I mean, I think for the most part, all the banks are kind of down today. So you can see Bank of America is down 3.66%. This is a position that I am building back up, which I'm so excited that it's actually coming down. So yes, absolutely excited here. But yeah, this is my favorite bank actually. And then you also have Citigroup, which has still been held in the portfolio. It was only held, and it was the only bank that remained. So when I did sell the banks, it was the only bank that remained, and it's down 4.28%. Citigroup, among the bigger banks, among the big four, is considered the most toxic of them. Bank of America, JP Morgan are considered the most pristine. Wells Fargo is the close third. And yes, so I'd say that it's these are going to be distressed. You can see Citigroup, if you're like P, oh my gosh, P of 5.38, you got to really understand what it is they own. They have a lot of counterparty risk. Again, that word coming back with Russia and a bunch of other places. They're going through some transition. The CEO still has to prove herself. Of course, Warren Buffett's given it his stamp of approval, and maybe you want to build a position now. If I actually looked at it now, it's getting to the price point where I actually would consider buying more of it. But I'm more concerned about building out my Bank of America holding. I'd rather have that bank if I need a bank, and I want at least one bank right now in the portfolio, and I'm excited. I don't know. I just actually like Bank of America. But yeah, that being said, again, yes, my strategy shifted with banks, and then now I'm kind of rebuilding it. But all in all, it doesn't change. It's not timing the market per se. I haven't exited my entire portfolio. I remained with a lot of it. And of course, remember, I want to highlight that I do videos on holdings I have in the portfolio, and I try to be, as always, as unbiased as possible. I did a video on Google, my largest holding. Told you guys I thought it was overvalued. Hindsight, it was, and now we'll see. I have to do an update, but I'm waiting for a good price to do the update for, and then see whether or not I would be adding to Google at this price point. But more likely than not, I'm not looking at it. I'm looking at other positions. Again, if you've been watching the channel, you know what those positions are. It's same old, same old. Oh, if you're not sure, wait for the portfolio update. There will be one this week for sure. I've been pretty busy with work, so all of that, kind of takes away my time. But we'll see on the stocks that you're about to see on VTRS and Olli's up next. What are we looking at with this company? Well, the company actually fell around 30% on the sale of an asset. Okay, that asset being their biosimilar business. And if I actually pull up VTRS stock, I'll actually highlight to you that precise moment in which case they experienced that 30% drop. And you can see it if you pull it up yourself on that 1 year, right around here, actually. Yeah, right around here. This massive drop here in early parts of the year was because they were going to sell their biosimilar business, which is the massive majority of their growth. Now, I want to also highlight to you there are different parts of the business that are of greater importance. For example, the rest of the world, including basically everything excluding Europe and North America, it makes a very small portion of their business. The majority of their business actually comes from North America and Europe. So we want to see that part. But however, we might be able to kind of conclude from that if the rest of the world kind of does grow over time, that's a potential, right? Grows in wealth, grows in its availability or spending in healthcare products. That's a positive for VTRS. I want to also highlight that this business is very, 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 how do you say, competitive, okay? A lot of low-cost Indian producers exist in this market, and they all compete for that cheaper and cheaper and cheaper pharmaceutical product, okay? VTRS is no different here. So VTRS appears to be cheap, and I actually want to showcase you, because you might be saying, well, right now it doesn't. But I promise you, that PE ratio right there of 78.87 was once upon a time, just the other day or month actually, was in the threes, okay? So in appearance, it appeared very cheap. Now, why is it not as cheap as it looks? Well, one thing is the debt. Now, the debt context comes from its history with Mylan. Mylan used to be the company that merged with Upjohn to create VTRS. Upjohn comes from Pfizer. And with that, they garnered a lot of brands from Pfizer, like Viagra and other things like Lipitor as well. So with all these brands, so to speak, they have that under the portfolio, and they're like cash cows. But Mylon back in the day, I know many of you weren't investing back then, but Mylon back in the day was actually acquiring a ton of companies within its sector. And they were doing so by taking on tons of debt. So all this debt kind of piled on, and they did what we always talk about here on the channel, empire build. They built an empire across their, respective field. And that is all well and good when things are great. You look amazing. You're a great CEO. Look at all this revenue growth. We bought this company and now our revenue's double. Well, doesn't look so good later down the line if things don't pan out, if the industry isn't as, sexy as it once was. We have the opioid crisis. We have all these kind of sentiment things. And you took on all this debt that's probably not as productive. I also want to, pay homage to Teva Pharmaceuticals, an Israeli pharmaceutical company, does basically the same thing. Same thing happened there. We pull out the max. I want to highlight they have the same exact price action as Mylan. You can see in 2015, they hit an all-time high, okay? And from there, boom, all the way down, okay? So that was the peak for this sector. And up until then, people were very excited about this sector. You could have seen, you still had great performance, or relatively great performance, about 1,528% from its IPO. From if you had bought, I guess, over the past 5 years, you're not too happy. You're down 74.19%. But these are examples of what I would consider to be value traps. Because at $30-ish a share, people were writing articles how cheap Teva was, how amazing Teva Pharmaceuticals was. Mylan, same thing. You would have seen the same similar things. And people not understanding the nuances of what is to come. Okay, what is the forward projections? What does the future look like for this company? What are some of the issues that might be lurking in the balance sheet? Teva Pharmaceuticals, I tell you right now, because again, maybe many of you probably never seen Teva Pharmaceuticals until today, had a ton of debt. Okay, a lot of debt on the balance sheet, a lot of liabilities on that section. They have had a new CEO who's come down, and he's been changing it. He's been making progress. I got to tell you, I got to be honest, I am watching both of these firms to see if the management can turn it around, because there is, at the end of the day, some value to be had here. It just depends. Teva's CEO has done a better job from what I've observed. Not enough for me to go, oh, I'm going to buy a ton of the shares. It's enough for me to notice and say, okay, you're on my watch list. I'll keep an eye out for you. VTRS, same thing. But VTRS, newer company, management comes from Mylon. So a lot of people have problems with that management team. And so, that they have some valid points. I'll just say that. Now, regarding the valuation, let's actually take a look. I just had to reload the page real quick, but that was it was still pulling in DocuSign. But VTRS actually has a price target of $15.80 by analysts, which is a buy rating, by the way. Buy rating nonetheless. So if you're here for the analyst thoughts, there you go. Okay. And a 46.43% potential upside. You can see, I just want to highlight, if I expect 0% growth all the way through from scenario 1 through 5, it says that it's a buy because of how cheap it looks on the surface. Now, if I take a look down here, the revenues are actually expected to come down a little bit there. Cash flows are expected to blow up. Now, why is this the case? Okay, now I'm going to tell you. Okay, so it's because they're selling that biosimilar business, right? What does that entail? Well, it entails $2 billion in cash injection into the business. Okay, so that might manipulate the cash flows in the future, and analysts in the estimates are accounting for that. So we want to keep that in mind. And that already tells me we're going to use a tool that I've created precisely for that. So analysts are saying $2 billion in cash is coming. About $335 million additional will come in 2024. And on top of that, they're going to get a $1 billion stake in the company that they're selling it to. They're not just giving it away with no equity. They're going to get some equity, which gives them a 12.9% stake in the company that they're selling it to. And by the way, this company is planning on potentially IPOing in 2023. So they might own some shares, or you might want to say, oh, I don't want to own that. I want to own this newer company because the biosimilar part of the business is better. All right. Maybe, maybe not. Now, we want to also point out that the leverage is pretty high. Let's go over to the ratios to actually kind of show that. So the solvency ratios is what I'll highlight. And I'm going to actually, let me move us here so you guys can see the line items. So you can see the line items on the left, and the right column will tell you if it's getting better or worse based off of getting higher or lower. So if you look at the solvency ratios, we do see that the financial leverage is pretty high, but it's been high since the recording of Mylon. All right. The new business together, it didn't really increase the leverage as a percentage of the business. So that we want to note that. But the leverage is generally pretty high. On a liquidity ratio, the current ratio is pretty good. That's fine. I can understand now, looking at the solvency ratio, why management is doing what they're doing. They're selling these assets because almost like they're trying to precaution something. And let me just tell you one thing, connecting the first part of this video, because I do think you see how even the macro environment does kind of affect micro in this instance. Because if we're in the point of a liquidity crunch, what do you not want to have a lot of? I'll pause here a little bit for some opportunity for you guys to think about it. And now I think that's enough time. I didn't really pause it, but I just, rambled a little bit for you guys to answer. So at this point, you should have your answer, and that is debt. You don't want debt. In a liquidity crunch, that is the worst thing you can have. You don't want a ton of unproductive debt or unsustainable debt, because in a liquidity crunch, in theory, you should have starving for collateral, starving for cash, and that makes it almost dangerous, like you're asking for it, like you're asking something bad to happen. And management probably knows this. They're very smart. I don't think that the management teams of these large publicly traded companies is necessarily stupid. I think they're all intelligent in their own regard, and that's why they got to where they are today. They can identify that this is the kind of the environment. They can identify, hopefully, that they need to prevent these level risks if they're working in your fiduciary. Okay, so I think that they're doing this, and it's a smart decision to deleverage the balance sheet, and that they are smart in doing it as aggressively as they are. Okay, when I like to highlight this, when I look at companies that are highly leveraged, if the management team isn't aggressively paying down debt, I will say to you, maybe that's good or maybe that's bad. Here I'm saying that's good. They're doing it. It's good. Their plan is, I guess, sound from what I've seen. And long-term debt has been coming down. Of course, the asset part of the business is also coming down. So some of these ratios are remaining relatively the same. Now, if we're looking at the profit margins here, gross profit margins have declined. Again, if I actually pull up, let me see from 2015. So 2015, where you at? So 2015, 2014, you can see how the margins have declined. So along with the stock price, the actual margins of this business are getting harmed here. Not necessarily the operating margins, okay, but the gross profit margins. So the ability for them to sell these products at attractive prices relative to its cost to produce is actually worsening. But their operational side of the business has remained about the same. And maybe they've actually improved some efficiencies in order to try to make up for that, which can be a little bit problematic and cause other issues down the road. Now, net profit margin, it's in the negatives right now, but they have some accounting stuff going on. If we actually look at the cash flows, right, we don't go down to the cash flow margins. They have a cash flow margin around 14.31% for this year. But the previous year, again, we probably some accounting stuff going on. The previous years after that, you can kind of see, we can estimate about 10, 12 around there. Some years really bad. So I think there was 2014 was 3.37%. If I look back at that time, I guarantee you it's probably some acquisition they were doing, because that's around the time Mylan was doing acquisitions. So under that historical context, we can kind of get that assumption. I also want to show you guys the transcript here. So if we actually look at the sentiment score, it doesn't get many mentions. That makes sense. But we want to look at the articles kind of just written. They were written lastly on the 8th, on the 7th, and on the 6th. A lot of dividend stock articles. So dividend stock articles, a lot of dividend investors might be looking at this and saying, oh, well, this yield is great. Lots of good dividend yield. So the actual dividend yield of VTRS, we actually pointed out, it's 4.45% today. So this is actually not technically up to date right now because it's not taking into account the actual payments. It's only taking into account the previous payments for the previous year. So keep that in mind. Now, with all this being said, I want to highlight some of these tools. I'm going to actually adjust the cash flows for anomalies, which is a tool that this is able to do. Okay, so after that adjustment, we actually see, okay, so it is not taking into account the growth. It's actually already done that for me. So good. I didn't even have to indicate for it. So that tells me that we from here have to kind of adjust whether or not we believe this is going to grow or stagnate. And I think more likelihood than not that the stagnation scenario is probable. But I also think we could have a decline scenario. So if we have a decline scenario, I just want to show you and highlight how cheap this company appears on the surface. 10.75 is the current today price as of filming. And the buy price, so to speak, at a negative 5% growth rate for 10 whole years is about 10.67%. Now, I think for something like this, we do require a greater margin of safety. We are pretty much at the price point where we could assume a 0% growth rate for 10 whole years. Stagnation, complete stagnation for this company. And we have a positive return possibility, a strong positive return possibility with a good margin of safety. So this, by all means, is a cheap company. Okay, where are the risks? Okay, where are the risks? I will highlight them kind of here now. But we have competition in India, kind of squeezing the margins further. We have regulatory risk, right? We have the risk of the debt. The liquidity crunch kind of gets out of hand beyond even what I could have predicted or what I could have imagined. And we see a massive contraction in terms of the ability for this company to actually finance themselves. Okay, that could be a problem. I think that the market is not mispricing this necessarily. I think the market is telling you that there's something wrong here. But if management can pull something out of this, the returns here can be fantastic over the next 10 years, okay? They can be, okay? Now, you have to understand that when you're getting involved with any kind of company that fits this criteria, that you're not getting this as risk-free. There is a lot of risk here. But if the risk kind of doesn't pan out here, you're going to have, perhaps you're going to look back and say, oh, wow, this was good. But will this be in my portfolio? The answer to that is not really, not right now. But do I think that it could end up there? Yes. And it could serve a particular purpose. That's not to say that it serves that purpose at the present moment in time. All right. And with that being said, I want to head over to Ollie's, which is the second stock. And we'll actually go ahead and put that in. While it's pulling the data, we're going to take a look at their price action over here on Google. And we see that today they're down 1.25%. They're at a P ratio, a GAAP PE ratio, mind you, of 29.64. And what do? Well, you know Dollar Tree, Dollar General. Well, yeah, they're like that, but they're just smaller. Okay, they're a smaller version. You can see the market cap is about 3.31 billion. There. And if we actually take a look at the price action over the 1 year, they're down 40.67%. Over the 5 year, they're actually up 29.55%. So what do I want to tell you about this? Well, we talked about Ollie in the Discord calls, and we talked about them reporting earnings. What was key is guidance. Guidance was key. And what we actually see is the guidance was actually pretty strong. Okay, so we actually look at the 5-day chart. You can see because of that earnings report, they actually experienced a nice little bump, 8.38%. Investors were very surprised that, well, looking forward, the company's expecting some better performance. And they are down, or they were down in terms of sales growth. I think they were down about 8-ish%, something like that. I can't remember off the top of my head, but they were down decently. And some investors might look at that and say, oh, revenue growth is down, therefore bad. Well, let's not be so hasty to judge it. Let's actually absorb, or what is the context behind that drop in revenue growth? Well, if you look at the previous year, we had a bunch of stimulus, a bunch of impoverished people, you could say, or people who are less fortunate. They might shop or tend to shop at some of these stores. I personally don't care. I will shop at these stores. I will look for the bargain, okay? And Ollie's Bargain Outlet, if there was one close by, oh yeah, it'd be there. And if I can find something of value. So that being said, the stimulus ran out, and that obviously had a decline in some sectors of the economy more than others. So in particular, we see, okay, unemployment benefits, right? Child tax credits, right? Other forms of stimulus, stamps, right? The stamps, right? Improved, or not improved, but increased spending in stamps. So we want to also consider the fact, and when I said stamps, I mean food stamps, by the way. I hope the jargon didn't kind of sneak by. So with that being said, they're going to have a decline in sales. That's expected. And with that, let's actually move over to the valuation model. And the company does appear, we're actually going to remove the adjustments because we don't need them for this, I believe. At first, let's actually judge it in isolation. So revenues, okay, no, we are going to need this adjustments. So let's actually come back and make these adjustments. Because immediately when I saw this cash flow dip in 2022, I was like, okay, we're going to have to make some sort of adjustment here because we can't just let it go. Okay, we're going to have no cash flows. Shares outstanding, they've actually increased their shares, but I assume that's actually not necessarily the case that it grew that much. We're going to only take over the 5-year average anyway, so it's fine. So they have been diluting a bit, and we're going to assume that they continue to dilute by about 1-ish%. And let's actually assume some levels of growth going forward. And we actually see the revenue growth has been pretty strong. However, they are estimating a form of stagnation going forward. So that's a bit of a problem. Now, the normalization of cash flows, we are going to actually have to increase or we can actually even use this tool. This tool I think is going to be a little bit better. Okay, so yeah, this tool is going to be a little bit better for that. And we're going to assume that we're going to grow it from here. Now, the growth rates that they are projecting and what I've kind of penciled out is anywhere between 15% on the higher end, and that's assuming that they execute well, same-store growth, as well as expanding stores. They had about a 10% drop in same-store sales growth this year, but again, remember that context we were discussing. So they can still expand. They are a much smaller player. If they have this niche hanker down, they can improve and they can go from there. So 15% I think is on the higher end. It does indicate to me that the company is tremendously overvalued if I want that margin of safety. If I kind of remove that margin of safety, you're kind of already in there. I think we can also, I also had a 10%, 12%. I do think that there is a scenario where, although I think it's kind of pessimistic, a 0% growth and then a 5% growth kind of to implement that midpoint. So again, if we want that decent margin of safety still, we're still not really there. I'd probably assume a 10 to 12, a 15% is more of an optimistic case. And again, if you want a greater margin of safety, it's not there yet, but be patient. Maybe this liquidity crunch kind of gives you, as we discussed in the beginning. Remember, what is the winning strategy, okay? And everyone's gonna have a different strategy, but the broader winning strategy is finding assets you like at prices you like, acquire those, and don't worry about anything else. The upside will take care of itself, okay? Now, what you need to learn is how to identify those companies for yourself and how to pick out the ones that you do want to own, okay? So not only the ones you want to own, but what are the good prices to own them at, okay? Easier said than done. And then if you want basically no margin of safety, you're at the price point where you could assume some stuff. You're not really at the 0% growth level, but you're there. So with that being said, guys, that's my evaluation on Ollie's, my evaluation on VTRS, and also the pessimism, excitement that you guys might enjoy at the beginning or not. Again, check out the Instagram for those memes. I'm going to be reposting that meme because I think it's aged beautifully. I think it's also kind of funny, and it also addresses some of the things that people might find some humor while also, I guess, kind of pointing out things. Okay, it's just funny. All right, on that note, guys, thank you guys so much for watching, and I'll see you guys on the next one. Bye.